Hi there, Serial Trader here. We're going to have a look at the major US indices, and I'll just pull back here a little bit here. This is the hourly chart of SPX. Pull back to where we were at the pre-election lows. And from there, it really has been developing in a fairly textbook fashion, just typical impulse waves up, corrective waves down. So we got, by this count, the initial one up, we had the two down, and then we had the 1, 2, 3 triangle 4, 5 of 3. We had a quick pullback in 4 here. And then I think where we are now, as far as the wave count goes, I believe, and let me just zoom out a little bit here, just to get the right look. What I believe we're in now is this larger wave 5 of potentially a larger wave 5 of potentially. Now this is up for some debate, obviously, that real large degree wave that we're in, but potentially a large degree wave 3. But there are ways you could label this where this is, the final fifth of a very significant degree, and the market's just going to absolutely fall apart afterwards. Not ready to go there yet, although got to stay open-minded. Doesn't really matter as far as trading goes. Right now, the trade is still looking for further upside, and I'll explain why that's the case. So I wouldn't get too wrapped up with calling the all-time, top of the year or top of the decade or whatever. That's not how you make money trading. You got to keep things in perspective here. So from this initial pivot we had down here in this fourth wave, this is clearly an impulse wave up. So I call that the initial wave 1. This looks like a nice ABC down for wave 2. Now, potentially we're working wave 3 here, and maybe this is like 1 of 3. But let's just work for some upward targets. And let me just point out, every time we go up, it's 5-wave impulsive looking move. Every time we go down, for the most part, we have this very corrective looking 3-wave decline. So until that changes, the market's bullish, and it's just going to keep doing 5s and 3s to the upside until something changes substantially. And we'll get to the point of what would have to change to kind of finally break the trend. I'll explain that in a little bit here. But first, let's just do some potential targets. So if we got our wave 1 of 5 here, this is 2 of 5. So let's just project some common relationships for 3 versus 1 of that larger 5. So a 1 versus 3, I mean, you always look for that typical 1618 level. It's always a good baseline to start with. So that 1618 level will get us to 4,014.94. So should that occur, and we get our wave 3 up here around the 4,000 level, well, you'd still be looking for a wave 4 pullback, and then another move up in wave 5 of potentially that 3. So by this count, and by the pattern, even the short-term pattern here that we have in development, 5 up, 3 down. Looks like another 5 up in development. So we're looking higher here still on a relatively shorter-term basis. The wave count to the upside just doesn't count as complete at this point. And I wouldn't even dream of trying to short this thing until we can at least have a mature looking wave count. But that's not enough. What I'd really want to see, and let me drag us down here. So let's say we get the 1, 2, 3, 4, 5, somewhere 4,000-ish or maybe a little more. We'll see once we get closer to that area. What would really entice me to actually try and short some futures, or potentially put on some sort of bearish option play, would be something like this. You would need that real clear impulse wave down, taking out multiple prior short-term resistance levels, very directional. Okay, that's what you'd want to see. You need that. Now, if your goal is to try and catch that first move, it's very difficult because you have nothing. Every time you try and say, oh, I think we've topped here, I'm going to, go bearish here, it can always just keep crawling and creeping and crawling a little higher. And where do you put your stop? Well, I think it stopped here. Well, I think it stopped here. Well, I think it stopped here. You don't have a clear level that the market has rejected, for instance, to actually define risk against. So you're basically just guessing. Whereas here, you let the market call its own top. You let the market tell you where the top is, okay? And you get that real nasty initial wave down, whether it be an A wave or a 1 wave, whatever. Nice, clean 5 waves down. You get that, okay? And at this point, you should still just be observing, unless you really want to be short-term and try and play these smaller wave subdivisions, you can do that. But for like a larger swing trade setup, you let that happen. The big 5 waves down. Then you wait for something clearly corrective, okay? A 3-wave corrective rally after that 5 waves down. Let me just get this degree in sync here. Then that potentially, if it develops like this, you get that 5 down, 3 up, and then you would do, some common fib levels and all that good stuff. Once you do that, and you get this setup, if and when you get this setup, this is the potential opportunity to short the market, sell futures, buy puts, buy vertical put spreads, whatever. Doesn't matter what strategy you're going to get involved with, but what matters is how do you define the trade. And at this point, you would be able to clearly define your risk. You'd say, okay, I'm going to go short here, or buy these puts here, or whatever. You would do that, and saying, I will abandon the trade if it takes out this prior high where the market was rejected and had an impulsive decline. Okay, so then you'd have an actual trade setup where you'd have a risk-reward ratio and a true level to define the trade against. Okay, like a line in the sand. Whereas, let me just get rid of this now. Whereas over here, you're just saying, oh, I think that's the top. Oh, I think that's the top. Oh, I think that's the top. And then you'll be right once, but you'll be wrong the other 100 times, or whatever. So that would be my approach here. Yes, the market is obviously very extended. Yes, it's very overvalued, historically so in many ways. But until the pattern actually completes to the upside and you actually start a pattern to the downside that you recognize, it's just too early to short. Why sell short at 38.50 if you're going to go to 4,000 or 4,100 or whatever and have that big move against you, just hoping that the top comes in soon. That's not the strategy. So the strategy here, if you don't like how extended it is to the upside and you don't want to try and play for these last few moves to the upside, you can just stay in cash. Don't have a position. You don't always have to be involved in a trade. I know it sometimes feels like you need to be because the market's open every day. You see all this action. Oh, I should be involved in some way. Well, maybe you shouldn't. Maybe sometimes the best thing to do is wait for a real clean textbook setup, and then pounce. Be more of a opportunist. Don't feel like you always have to be in this thing. Now, me personally, I'm still long. I will continue to adjust the stops up here, and basically every time we get a little swing low here. Swing low, I just move the stop up to that level once it reacts nicely off that level, and eventually I will get stopped out, and that's fine. But that's kept me in this, being long in the market since way over here, pre-election, like in this area. So it's kept me in the game here for a lot of this move. I may not get the exact top, but I've caught a good chunk here. Okay, so that's really what I wanted to go through on SPX. So bottom line is, at least on a fairly short-term basis, the benefit of the doubt is still to further highs. And we know what to look for if the trend breaks. We'll look for that corrective bounce up after an impulsive, crack down there for a bearish trade setup. But right now, I would not be getting involved with bearish-oriented trades. Not yet. That time is coming, but just not yet. Okay, that's probably enough. I'm kind of beating that to death here on SPX. Well, let's go to the Thinkorswim candlestick chart. So SPX daily chart, a little doji star on Friday, a little doji star on Thursday. Basically just kind of meandering near the highs. No clear bearish reversals or anything, even on the daily bars. So daily candlesticks still nothing there to take you away from staying bullish here. Weekly candlestick, SPX. Closed higher end of the range. A weekly closing high. A new all-time high for the week. Overall, fairly, at a loss for words here. An uneventful candle, let's put it that way. Just further upside. A green candle within a still developing weekly uptrend there on the weekly. Okay. So yeah, that's SPX. We'll go to the Dow Jones Industrial Average. Dow kind of reacting off the T-line here. Again, Doji star on Friday. Maybe a little bit of a reversal pattern in development here. You had the Doji, then you had the movement down. But again, I mean, we're not even taking out any kind of support levels here. Like, this would be your first support level here on the Dow. And what's that? 30,612. And then you got the 20-day simple moving average here that will probably bounce off of if we even touch it. So there's a lot of work to be done to actually break this uptrend, and it's just not happening yet. Weekly candle on the Dow. Okay, maybe a little bit of a rejection of the highs there, but still just not enough power there to dissuade me from staying bullish, at least short term. Okay, that's the Dow. NASDAQ composite. Let's have a look. So NASDAQ composite, I mean, that's pretty bullish. You closed near the highs of the day, made a new intraday all-time high, new closing high. So nothing bearish about that. Weekly candle, that looks, very powerful, almost a shaven top for the week. So closing near the highs of the week, you're going to have likely some continuation the following week, right? So again, nothing bearish there. NASDAQ composite, okay, that's all good. Now the VIX. VIX kind of just grinding out near the lows, but one thing to note, the VIX is not going down anymore. It's just, if anything, it's making slightly higher lows despite the market making higher highs. So that's usually a condition you would look for that would precede a larger drop in the market. You want to see the VIX kind of stop going down, maybe start going up slowly while the market's still going up. That's kind of like the little early warning sign that, okay, the implied volatility of SPX options as measured by the VIX is stabilizing or going up, even though the market's going up. So that to me means that the big boys are buying their bear plays and keeping things kind of elevated on the implied volatility side. So they always like to get loaded up before the crash. That's what professionals do. They like to be hedged, and they're usually pretty good at timing their hedges, at least some of them. Okay, so that's the VIX. So again, grinding out higher lows, a little bit of an early warning sign. The VIX VVIX tool, look at that. Now, there's been this long, now there's obviously lots of little divergences for shorter term trades, if you will, but what I'm looking at here is kind of this longer developing divergence. So you got VIX and VVIX kind of grinding out higher lows, even though the market is making higher highs. So that's the divergence. Normally, VIX and VVIX are trending down as the market's trending up. Now that's no longer the case. So that's kind of the first step to a larger reversal. So eventually, this will kind of come to fruition. You'll have VVIX get above the red moving average. You'll have SPX get below the blue moving average, and you'll have a confirmed sell signal. And it could be a fairly powerful move down with such a large and kind of long in development divergence here in the making. But it's just not there yet, okay? It's something that we're watching. It's something that we're expecting eventually. But importantly, it's just not ready yet. It's not there yet. So I would say the pressure from a trading perspective is still to the upside. Long trades should still be favored until we see something to change our perspective on that. And we're expecting that to happen. I would just kind of anecdotally think, I doubt we get outside of quarter one. So I doubt we get outside of March into April without starting a fairly large degree pullback, which is actually fairly typical. All, Elliott waves and other technicals aside, quite often we have, a large correction in the first quarter of a year. Not every time, but it's one of those kind of seasonal tendencies that's worth being aware of. So I do think it's coming relatively soon. I mean, really, a few weeks or months isn't that long in the big scheme of things. But just right now, like at this very moment, it just doesn't look like it's ready yet, and it still looks like there's some more upside left. So I'll leave that as kind of the final message here. If you are long, certainly keep your stops reasonably tight. Don't be too aggressive with your size, especially putting on new positions here. And we'll check in again when something interesting happens. For now, just stay with the trend carefully. All right, Serial Trader signing off.